Welcome to The Economist in Your Ear podcast. Have you ever considered that the biggest financial revolution might not arrive with a thunderclap, but maybe with a quiet, persistent hum? Today, we're exploring a really captivating question, sitting right at the crossroads of emerging tech and, well, established finance. Is the world truly on the brink of a big bang in crypto that will fundamentally reshape how we handle money? We've been looking at a recent column from The Economist. It paints this vivid picture, of a financial transformation driven by stablecoins and tokenization. It's a compelling narrative, no doubt, especially with the recent signing of the Genius Act, which apparently offers a new layer of regulatory clarity for some crypto innovations. But, well, like with any bold prediction, it's really essential to look beyond the headlines, isn't it? To unpack what's truly unfolding.
Precisely. And while the article certainly highlights some significant shifts and some pretty impressive growth figures, our goal here is to layer in some additional context, maybe offer alternative perspectives, and definitely raise some critical questions. We want to provide you with a comprehensive understanding of this landscape, moving beyond just, summarizing the current trends.
Okay, so let's unpack The Economist's core argument then. The column signals this major turning point. It suggests crypto is finally moving past just speculation towards tangible, real-world utility. They point to the signing of the Genius Act by President Donald Trump on July 18th as this pivotal moment, providing much-needed regulatory clarity for stablecoins. And it's framed as a significant step away from that whole Wild West perception that's often shadowed crypto.
Right. And this newfound regulatory certainty, as the article details, has indeed prompted a flurry of activity on Wall Street. You can see that. On one side, you've got figures like Vlad Tenev, CEO of Robinhood, who boldly envisions this new tech becoming the backbone of the global financial system. Quite a statement. But then on the other side, you have Christine Lagarde, president of the European Central Bank, expressing profound concern. She goes as far as labeling it the privatization of money. What's striking, though, is that both sides, despite these, vastly different takes, they both acknowledge the immense potential scale of this change. It really underscores the high stakes involved here, doesn't it, in this evolving financial landscape?
Yeah, it really does. And a crucial point the article brings up is its focus on tokens as wrappers or digital vehicles for other assets. This concept isn't entirely new, is it? It sort of reminds me of how innovations like ETFs or securitized debt transformed finance, not by creating entirely new assets, but by changing how existing ones are packaged and traded. It suggests the power here is really in efficiency and accessibility, maybe more than outright invention.
Exactly. And the numbers they cite are pretty eye-catching, showing that rapid growth. $263 billion in stablecoins now in circulation. That's a remarkable 60% increase in just 1 year. Standard Chartered even goes further. They're projecting this market could reach an astonishing $2 trillion within 3 years.
Wow, $2 trillion.
Yeah. And we're also seeing major traditional financial players, not just, crypto natives, making significant moves. JP Morgan Chase has their JP Morgan deposit token, and BlackRock's tokenized money market fund, well, it now holds over $2 billion. These aren't just niche experiments anymore. These are established giants staking a real claim.
The promise seems pretty straightforward then. Stablecoins offer the potential for cheap, fast transactions, especially useful for cross-border payments. The implication is a direct challenge to traditional players like MasterCard and Visa, who usually take that, 2% margin?
Right, the interchange fee.
That's a significant saving. It's easy to see why it's attractive. The article even mentions leaked reports about giants like Amazon and Walmart exploring their own in-house coins, which could fundamentally reshape how consumers interact with those brands. Imagine paying for groceries with a Walmart coin directly.
It's a powerful idea. And beyond stablecoins, the article highlights tokenized assets, these digital copies of stocks, funds, even private equity stakes, making less liquid assets potentially far more tradable. Now, The Economist does acknowledge that some offerings, like tokenizing individual stocks for 24-hour trading, might seem a bit gimmicky.
Yeah, I saw that.
But it argues that tokenized money market funds offer a very real advantage, potentially yielding 4% compared to, say, typical savings accounts, often under 0.6%. Larry Fink of BlackRock, a real titan in the investment world, he even predicts tokenized funds will become as familiar as ETFs are today.
So for him, it's not just speculation.
No, it seems like a clear vision for the future of investment from his perspective.
Okay. Now, this is where maybe we start to see a slightly different picture emerge. While The Economist's vision is certainly compelling and it paints this picture of rapid change, When we look at some additional information, a more nuanced reality comes into focus. This idea of an immediate Big Bang revolution. Maybe it's overstating the short-term impact, perhaps conflating a long-term evolution with an overnight explosion.
That's a crucial distinction, I think. If we connect this to the broader financial system, the actual scale of this revolution, well, it's still relatively small right now. Tokenized real-world assets are currently around $25 billion. To put that in perspective for you, that's roughly 0.003% of global financial assets. Tiny, really.
0.003%? Yeah, that puts it in perspective.
Exactly. And even Standard Chartered's ambitious $2 trillion stablecoin forecast. If it materializes in 3 years, that would still amount to less than 4% of global bank deposits.
Yeah.
So, while it's undeniably a significant trend, it seems to be unfolding more like a fuse slowly burning towards an eventual impact rather than some sudden detonation. The timeline here really matters.
And looking closer at stablecoins specifically, while The Economist accurately notes their overall size, other data points to a significant concentration risk within that market, doesn't it? We're seeing a float around $250, $260 billion, which lines up with their figures, yeah. But a striking 89% of that total value is held by just 2 issuers, Tether and Circle.
That's right, too.
That's a huge amount of market power and potential systemic risk concentrated in very, very few hands.
Which brings up an important question for you to consider. Is the main risk just about the total volume of stablecoins, or is it perhaps more about this extreme concentration? This concentration, maybe more than just the overall scale, is what truly amplifies the systemic danger.
Right, because if something went wrong with just one of them...
Exactly. If an issue were to arise with even one of these dominant issuers, the ripple effect across crypto and potentially into traditional finance could be substantial and hard to contain. It really shifts the risk profile from diffuse network to just a handful of critical points.
Okay, so the article also praises the regulatory certainty supposedly brought by the Genius Act. But does this act truly usher in some kind of Wild West of unbridled innovation? Or is the reality actually far more controlled than maybe the initial excitement suggests? Regulatory clarity can sometimes sound like a free-for-all.
But the details often tell a different story, yes. The Genius Act is, in fact, far more restrictive than some might assume. It specifically treats stablecoins as non-interest-bearing payment tokens. It mandates 100% reserves in T-bills or cash, and it brings issuers squarely under the Bank Secrecy Act.
Non-interest-bearing, that's key.
It is. This structure explicitly curtails that kind of yield-hunting behavior that fueled many earlier crypto blowups. So while Christine Lagarde's concern about the privatization of money is certainly valid, it's also clear U.S. legislators share some unease. The act precisely forbids interest on these stablecoins and gives the Federal Reserve a direct veto if they grow to be systemically large.
A veto power. Interesting.
Very. So the underlying debate isn't just EU versus U.S. regulatory approaches, it's more fundamental. It's about central bank money versus what's called narrow bank money.
Narrow bank money. Explain that a bit.
Essentially, it's where private firms issue money-like instruments, fully backed by safe assets, like T-bills. They operate a bit like banks, but potentially with less oversight.
Okay. So it challenges the central bank's role.
Exactly. It challenges the very nature of monetary control. Is it public, or is it private entities acting like narrow banks? That's a core tension here, and it introduces new systemic risk questions.
Got it. Okay, what about some of those promised benefits, like 2007 trading for tokenized stocks? The Economist acknowledges it might be gimmicky, but our analysis suggests it might even be, well, counterproductive for the average investor. Why is that?
Yeah, you're right to question it. Take Robinhood's stock tokens, for example. They don't give you voting rights, and they fundamentally rely on a derivatives wrapper. Regulators are already warning that holders could find themselves at the back of the queue in bankruptcy court if things go wrong.
Not ideal.
Not ideal at all. And it really undermines that rosy picture of friction-free, continuous trading. Plus, genuine price discovery is already pretty thin during traditional after-hours trading. Introducing these 245 crypto venues could actually make market fragmentation worse, not better. Harder to get a fair price.
So less efficient, potentially.
Potentially, yes. Regulators are actively looking into fair pricing rules in this new setup. This use case, frankly, looks more like marketing appeal than a real liquidity gain for most people.
The article also points to the threat to traditional bank deposits, suggesting even a 10% retail deposit leak could significantly raise bank funding costs. Is that a direct, immediate threat, or is the story of deposit flight more complicated?
Well, banks are certainly feeling pressure, no doubt. But the flight of deposits to these new digital avenues will likely be a slower, more cyclical process, not a sudden flood. Remember, as we just said, the Genius Act bars interest on U.S. payment coins. That limits their appeal purely as a place to park savings.
Right, the non-interest-bearing part again.
Exactly. And while those tokenized money market funds do pay competitive yields, 4% or more, they're securities funds. This means they're subject to specific rules, like Rule 2A7 for money market funds, which adds oversight and redemption rules.
So there are breaks built in.
There are breaks. So while that 10% leak is a sort of quantified hidden cost of this privatization of money, the existing mechanisms and the new rules are explicitly designed to slow that outflow and manage it. It's not a sudden crisis, more like a steady trickle that banks need to adapt to over time. Strategic adaptation, not panic stations.
Okay, that makes sense. So the risks aren't just about individual retail investors losing out potentially. A significant concern, maybe less discussed, is the operational risk at a systemic level that affects the whole financial system.
Absolutely. While the economist piece focuses a fair bit on retail protection, like the holders of Robinhood's tokens in a bankruptcy scenario, the resilience of the wholesale infrastructure that underpins all this matters just as much, if not more, for overall stability.
Can you give an example?
Sure. Look at BlackRock's BUIDL fund. It holds $1.7 billion in treasuries, a significant sum, but it operates on Solana. And Solana as a blockchain has unfortunately suffered multi-hour outages in the past.
Right, I remember reading about those.
That kind of operational fragility on public blockchains, especially when they're handling billions in financial assets, is a profound systemic worry. It's not just a small retail issue. And SEC Commissioner Hester Peirce, crypto mom herself, famously stated, tokenized securities are still securities. Meaning all the existing legal and regulatory obligations, complexities, protections, they follow the asset, no matter what fancy digital wrapper it's in. It's a crucial detail many promoters tend to gloss over in their excitement.
This whole discussion definitely raises some really important open questions, doesn't it? Potential blind spots maybe not fully explored in the original article. What does this all mean for the financial system as a whole, and maybe more importantly for you, the listener, navigating this evolving landscape?
Well, one critical insight for you to consider involves collateral feedback loops. Imagine if $2 trillion of stablecoin reserves really do crowd into the short-term T-bill market. That could create scarcity in those super safe liquid assets.
Okay, so what happens then?
Well, that scarcity might push hedge fund repo volumes, that crucial short-term borrowing market, into riskier, less liquid paper. It has echoes of that chaotic 2019 Dash for Cash event, when a sudden repo funding shortage sent tremors through the system.
So seemingly safe things causing unexpected risks elsewhere.
Precisely. The insight is that even safe innovations like stablecoins can introduce new, systemic liquidity risks through how their reserves are managed, potentially triggering unforeseen market instability.
And then there's the platform issue. You mentioned BlackRock on Solana, JP Morgan on Base, BNY Mellon on a private chain. That's a lot of different systems. We have to confront chain fragmentation, right? These interoperability layers, the bridges allowing these different digital rails to talk to each other, they're still pretty thin, aren't they?
They are quite rudimentary, yes. And this raises significant post-trade headaches. How do you ensure settlement, clearing, reconciliation across all these disparate, often incompatible systems? The column barely touches on this, but it's a huge practical question mark for widespread, efficient adoption.
Yeah, that lack of seamless communication could create new friction points, new risks, undermining the very efficiency they promise.
Exactly. Another crucial question for you to weigh relates to run dynamics under the Genius Act. We talked about the 100% T-bill backing, preventing a credit run the issuer won't default. But it doesn't necessarily prevent liquidity run.
How so?
If there's a mass redemption, a rush for the exits from a stablecoin, those underlying T-bills would need to be sold quickly, potentially dumping massive volume into an already stressed market. This scenario strikingly mirrors the March 2020 money market fund turmoil. Investors rush for cash, forcing funds to sell assets into an illiquid market, needing central bank intervention.
So new tech, same old financial risks, just in a new guise.
It often just transmutes them, yes. New technology doesn't inherently eliminate fundamental financial behaviors or risks.
And finally, we have to consider antitrust issues and walled gardens. Could a Walmart coin or an Amazon Pay dollar effectively lock shoppers into captive ecosystems?
It's a real possibility. Imagine your preferred digital payment for groceries offers exclusive discounts, but it's only accepted at that one retailer. creates a closed-loop environment.
Which sounds a lot like the old fights over credit card interchange fees.
But potentially on a blockchain this time.
Exactly.
Legislators are already hinting at needing network access rules, signaling this isn't just a tech discussion, it has significant implications for consumer choice and market competition.
So, wrapping this up, what does this all mean for you? The Economist is right, clearly, that clearer rules and the promise of real yield are pulling crypto out of its purely speculative phase. The promise of faster, cheaper transactions, more accessible assets, it's definitely compelling. It's a development worth paying close attention to.
Yet that headline Big Bang arguably underplays the very real concentration risk we've discussed. It perhaps overplays the immediate universal benefits of things like 247 trading. And it largely skims over the powerful policy tools, interest bans, strict reserve mandates, the Fed's veto power that are explicitly designed to keep any potential blast contained. It's not quite the uncontrolled explosion some might imagine based on that framing.
The revolution, then. It seems it's certainly coming, but maybe it arrives in quieter, heavily supervised increments, not with that cosmic thud the column sort of implies. A gradual, nuanced transformation, perhaps, not a sudden, dramatic shift.
And that leaves us with a provocative thought for you, the listener, to consider. Knowing all this, what does the future of private money truly mean for your personal finances, for your investments, or even just how you conduct everyday transactions in the years ahead? It's certainly more than just a passing tech trend, and understanding these nuances that will be key to navigating the future, wouldn't you say?